Joining me now is TD Cowen senior retail analyst John Kernan. John, it's good to have you here. What's the setup, into Ross and the remainder of retail season? We've obviously heard from Walmart, also, of course, heard from TJX a few days ago or a couple days ago. So how do things look from here?
Yeah, sure. Broadly, retailers and consumers are showing decent strength as we head into the fall. We're almost through Q2 earnings season. We've had some good positive surprises to the upside, but also some nasty downside surprises. The environment from both the top-down and bottom standpoint is extremely bifurcated at this point.
And what are the implications of that bifurcation, let's say on Ross, just to keep it immediate?
Sure. Ross Stores is a cousin of TJX. TJX yesterday beat and raised, stock at an all-time high. It went to its all-time peak valuation multiples. Ross serves lower income consumers. It has a similar financial algorithm to TJX. There's a huge valuation discount between Ross Stores and TJX right now. It's about 25% on a PE basis. We think that can narrow. We like the initiatives the new CEO, Jim Conroy, has in place. And we think they'll report some upside to Q2 same-store sales and EPS. And we think they will initiate full-year guidance tonight after the close. It'll be fairly in line with consensus expectations.
And what, in your view, has accounted for that wide valuation discount opening up between TJX and Ross? Is it geography? Is it the customer segment that Ross is more exposed to?
It's both. There's fear built into the valuation of Ross. We think it's related to 50% of their stores being in border-like states, California, Texas, Arizona, Florida. They have a very heavy Hispanic exposure and lower income exposure. They're dealing with lower income consumers than TJX. They have different brands in the store. They service consumers with different price points. But we do think comps can accelerate to 3% in the coming fall quarter, and we think you'll see better gross margin trends. So that can close the gap, we think, versus the current valuation gap versus TJX.
And then more broadly speaking, I know you were taking a look at how back to school is pacing and some of the trends and maybe chains positioned to benefit from a little bit of an apparel cycle in particular.
Yeah, two of our top picks, Ralph Lauren, Amer Sports, have had tremendous innovation. The brand management from the management teams has been tremendous. We continue to see positive estimate revisions based on better than expected sales and gross margin. These companies are well positioned to deal with tariffs, and a lot of companies are not well positioned to deal with tariffs. My 20 stock coverage list, they owe the U.S. government collectively about $3 billion in profits. So, like I said earlier, it's going to be a bifurcated environment. Those with pricing power, those with innovation are going to win.
And those companies you mentioned being better positioned on tariffs, is that, I guess, a lasting advantage in the sense that they can continue if these tariffs remain on? Or has it been a front-loading and inventory management effect so far?
Yeah, they've managed inventory very well. They have pricing power. They also are internationally diversified. So in the case of Amer Sports and Ralph Lauren, less than 40% of their EBIT is coming from North America and the United States. So that's a help. And they also have brands with pricing power. And if you can raise price and realize that raised price increase, mid-single digits to high single digits, you can offset the tariffs and even see some margin expansion. And that's what we've heard from some of these companies, that they're in a position to mitigate tariffs. Now, on the flip side of that, there are many companies that are not positioned to do that. And that's where you've seen the downside to earnings. And you'll continue to see that into the first half of next year because of higher cost inventory is going to flow through.
I was going to mention, where it seems like the companies have it tougher. Is it in footwear or is it particular categories?
It's broad-based across multiple categories. It's the companies without pricing power, without innovation, without enough demand that are over-inventoried and are over-reliant on the U.S. market in particular. We've seen some big downside surprises from Under Armour, Columbia Sportswear, and others. And I think you'll continue to see some downside surprises as we get into the back half of the year from others.